Welcome. If you're around 30 and worried you started late on retirement, take a breath. You haven't missed the boat. Today, we'll show you how to crush high-interest debt, invest in the right accounts, and let compound growth work for decades. We'll also clear up confusing advisor advice and share a realistic path to the first 6 figures invested. Let's begin, and then we'll walk through a practical roadmap. Here's our roadmap. First, we'll reframe timing anxiety and show why starting at 30 is common, not catastrophic. Next, we'll address high-interest debt and why eliminating it often beats investing. Then we'll move into account selection and investment choices. After that, we'll talk about advisor pitfalls and wrap up with a practical, step-by-step plan and a couple of quick quizzes to test your understanding. Let's transition to the core mindset. Starting at 30 is normal and still leaves you roughly 3.5 decades to harness compounding. The key is to shift from panic to a strategic plan. Eliminate costly debt, automate saving, and invest in growth assets. With consistent steps, many people go from zero in their early 30s to meaningful balances by 40. Now, let's quantify why time from 30 onward still matters a lot. Compounding still works powerfully from age 30 because you likely have around 35 years until traditional retirement ages. For example, contributing $100 per month at a 7% annualized return can grow to roughly $180,000 by age 65. If you can raise contributions over time, you'll reach the $100,000 invested milestone sooner, which is a psychological and mathematical tipping point where growth becomes more noticeable. Next, let's discuss the single biggest threat to compounding: high-interest consumer debt. This flowchart lays out the debt-first decision tree. Start with your paycheck and verify an emergency fund target of 3 to 6 months of expenses. If that's not met, prioritize building it while making minimum payments on debts. Next, check for any high-interest consumer debt, typically over 10 to 12% APR. If such debt exists, prioritize paying it off aggressively using the avalanche method, while still capturing any available employer match if feasible. Once that high-interest burden is eliminated, follow a contribution sequence. Secure the 401k employer match, then fund a Roth IRA up to the annual limit, then contribute more to the 401k, and finally invest through taxable index funds as needed. Ensure that invested funds are placed in growth assets rather than sitting in cash. Conclude with automation and annual rebalancing. First, build a basic emergency fund to avoid new debt from surprise expenses. Then list all debts by APR and use the avalanche method, which targets the highest interest rate balances first, while making minimum payments on others. Apply any extra cash flow to the top APR until it's eliminated, then roll those payments to the next debt. If possible, negotiate lower rates, or use balance transfer promotions with a clear timeline to pay off the balance before promotional periods end. Aside from capturing any employer match, pause investing above that level until the toxic, high-interest debt is cleared. Celebrate small milestones to maintain momentum and keep rolling payments forward. Next, with debt under control, we'll focus on which accounts to use. On the left, the Roth IRA allows contributions with after-tax dollars and offers tax-free growth, with the added flexibility of withdrawing contributions, though earnings have rules and penalties. It usually offers a wide range of low-cost investment choices. However, it has lower annual contribution limits. On the right, a 401k may offer traditional pre-tax or Roth features and often includes an employer match, which is essentially an instant return. Contribution limits are higher, but investment options are limited to the plan's menu. A common approach is to capture the full employer match first, then fund the Roth IRA, and then increase 401k contributions. Now, let's quantify how different monthly savings translate over decades. This table provides rough estimates of future values at a 7% annualized return over about 35 years. $100 per month grows to roughly $180,000. $300 per month to about $540,000, $500 to about $900,000, and $1,000 to around $1.8 million. These are estimates, not guarantees. Your actual results may vary depending on fees, returns, and consistency. Next, let's ensure your money is actually invested and not left idle in cash. For long horizons, prioritize growth assets. Typically broad, low-cost stock index funds. Early in your journey, an allocation between 80 and 100% stocks with a small bond buffer can be reasonable. provided it matches your risk tolerance and allows you to stay invested through volatility. Ensure your contributions are not defaulting into a cash or stable value fund unintentionally. If you prefer simplicity, a target date index fund can set allocation and adjust over time automatically. Automate contributions directly from each paycheck and reinvest distributions. Rebalance annually or when your allocation deviates materially. Now, let's test your understanding with a quick quiz. Question: you have credit card debt at 22% APR and $300 per month to allocate. Which action typically offers the highest guaranteed return? Options. 1. Invest $300 per month in an S&P 500 index fund. 2. Pay off the 22% APR credit card debt. 3. Buy a whole life insurance policy. 4. Hold the $300 per month in cash for flexibility. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to pay off the 22% APR credit card debt. Eliminating such high-interest obligations is the equivalent of securing a near-guaranteed return that the market cannot reliably match in the short term. Once that debt is gone, you can redirect the cash flow to investing. Next, let's cover advisor pitfalls so you avoid costly detours. Exercise caution when selecting advisors. Many so-called advisors are commission-driven salespeople. Prioritize fee-only fiduciaries with a clear, transparent compensation model that aligns with your interests. Avoid bundling retirement investing with high-fee, complex insurance products, such as whole life policies, unless you fully understand the trade-offs and specific use cases. Sometimes, self-education or a limited-scope, fee-only session for budgeting and planning is the safest option. With that in mind, let's solidify your do-it-yourself toolkit. Choose a budgeting method that fits your style, such as 50-30-20 or zero-based budgeting. Build an emergency fund of 3 to 6 months in a high-yield savings account. Sequence your contributions by capturing employer matches first, then funding a Roth IRA, then returning to the 401k, and finally investing in taxable accounts when appropriate. 50. Favor low-cost index funds to minimize fees. Automate contributions on payday and increase your savings rate after every raise. Track your net worth monthly and rebalance your portfolio annually. Finally, check current IRS contribution limits each year as they can change. Next, a quick second quiz to reinforce the compounding concept. Question: saving $300 per month from age 30 to 65 at a 7% average return grows to approximately how much? Options: $150,000, $300,000, $540,000, or $1,200,000. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is approximately $540,000 over roughly 35 years, $300 per month at 7% compounds to the mid-six figures. Your exact results depend on returns, fees, and consistency. Now, let's add a simple markdown cheat sheet you can screenshot for reference. Here's a compact reference. First, a quick order of operations. Build the emergency fund. Eliminate high-interest debt. Capture the 401k match. Then the Roth IRA. Then more 401k. Then taxable investings. Second, the future value formula illustrates how monthly contributions compound over years at a given rate. Third, a checklist to keep you on track. Automate contributions. Raise your savings rate after each raise. Keep fees very low, and stay invested through market volatility. Next, we will visualize the full account prioritization flow in another diagram to cement the steps. This flowchart shows the full sequence. From your paycheck, verify your emergency fund target. If it's insufficient, build it. If you carry high-interest debt above roughly 10% APR, prioritize paying it off using the avalanche method. If not, contribute to your 401k at least up to the full employer match. Next, fund your Roth IRA up to the annual limit if you're eligible. After that, increase your 401k contributions further, and finally invest through taxable accounts as needed. Throughout, place funds in growth assets rather than letting them sit in cash. Automate contributions and rebalance yearly. Now let's crystallize the main ideas. These are the key takeaways. Starting at 30 gives you ample time for compounding. Eliminate high-interest debt first, as it provides a strong, near-guaranteed return. Follow a contribution order capturing employer match, then Roth IRA, then additional 401k, and finally taxable investing. Allocate to growth assets, not idle cash. Automate contributions and rebalance annually. Be cautious with commission-driven advisors and seek fee-only fiduciaries. Finally, focus on reaching the first 100,000 invested to build momentum. Before we close, a brief disclaimer. This video is for educational purposes only and does not constitute financial, tax, or legal advice. Your situation is unique, and you should consult a qualified, fee-only fiduciary or other appropriate professional for personalized recommendations. Verify current IRS contribution limits and applicable rules, as these can change. Now, let's summarize your action plan. Here's your game plan. First, replace anxiety with action. Starting at 30 is a strong position. Second, crush high-interest debt and then invest for growth. Third, sequence accounts wisely and favor low fees. Fourth, automate, rebalance, and raise your savings rate after each raise. Finally, stay the course and aim for the $100,000 milestone to let compounding accelerate. Let's wrap up with a quick thank you and a call to action. Thanks for watching. If this was helpful, please like the video, share it with someone who needs a path forward, and subscribe for more practical money guidance. In the comments, share your starting point, your monthly savings target, and one action you'll take this week. Let's build wealth together.